Okay, so we're gonna talk about how to place a trade in the Thinkorswim platform. So we've got our monitor tab, trade tab, analyze, scan, market watch, charts, etc. There's a lot of information in all these tabs, just a plethora of information. You can spend quite a bit of time here. This is how you scan for stocks. This is great to check out what's going on in the market at the moment. This is the heat map, but you can see that on several websites. But it's kind of nice to have it on your platform. Analyze tab is something that we'll be using a lot. This is a more complex tool to help you figure out what your option trades will do. You can actually simulate what an option trade will look like in the future based off of price. So if a stock were to go to a certain price, it will actually tell you how the option will be performing in terms of profit or loss. And then your trade tab is where you put all of your orders on, and then monitor is where you see all of your current positions. So I'm going to jump right into setting up a trade, buying a call and buying a put. Which are two of the most common option strategies in terms of basic strategy. So I'm on Apple right now. Okay, the first thing that we want to do is this is how it typically comes out. This is your options ladder. Okay, it's going to give you all of the different available options that we can trade. You can see that goes this year alone, it goes all the way out to December 31st. So let's just bring up the first one here, the first yellow one, the 27th of November. And then you're going to see that I have a lot more than you do. So what we're going to do is we're going to put, you probably are on 4. We're going to drop this all the way down to 10. Okay, we don't want much more than that for now, just for demonstrating purposes. And then on the top here, there's a lot of different toggles that you can use. There's last price, net change, Theo price mark, volume, open interest, etc., etc. Let's go ahead and go to volume and open interest. And then here, the spread is our strategies. You can see we have a lot of different strategies here. So let's just go to single. Okay, so on the left side here, we have our call strikes. Okay, you can see that it says call strike right there, right? And then on the right side, we have our put strikes. Okay. So our bid and ask is what we would buy and what we would sell. So buy and sell. So I'm going to go ahead and set up a how to trade. I'm going to go ahead and set up an actual buying a call option on for example here, and then I'm going to do it for buying a put. So that way you understand exactly how to do this. So first things first is these are all of our these are all of the premiums, how much it's going to cost us. Okay. Here is the date. And here's our strike prices, okay? Now, there's a whole bunch of stuff that I can go into, but I'm going to try and keep this as simple and short as possible. Our strike prices is based off of the actual price of the stock. So you can see up here that the price of the stock, right here or there, you can look in 2 different places, is trading at 119.66, 119.67, right? So this strike price right here is the at the money strike price. It's the closest strike to what the current price is. The one above this would be considered in the money. Okay, so if price is at 119.69 and we buy a strike at 119, we're in the money, we're in profit. And vice versa, if you buy the 121 strike, you are out of the money. Okay, so all of these right here, 121, 22, 23, 24, out of the money. All these up here, 119, 18, 17, 16, in the money. So we're going to focus on the at the money strike right here. And we have two sides here. So to sell a call option and to buy a call option. Well, we're only focused on buying for right now, and selling, that there's time and a place for doing that as well, which we're going to do in the future. But again, this is just so you understand how to place these trades. Okay, so if we're just going to buy the 120, the November 27th, 120 strike, that's how you would say it. I bought the November 27th, 120 strike, and it's going to cost me $2.18 or $218 per contract, right? Now it's $2.16. So I'm simply going to left click and the order box comes down. Now, your order box may have different default settings. When you look at this, it may say +1 or +10. So you're just going to drop it down until it says +1. So mine started up here. You're going to drop all the way down until it comes to here. And I can show you how to change that default later. So we've got all of our orders up here. Single, we're on the buy side. We're going to buy one contract. We're buying the Apple stock. We can see that it says our expiration date there. We can see our strike price. We can see that it is a call that we're buying, okay? And we see that we're going to buy it for $2.14, which is a little cheaper. It's great. Let's lock that price by clicking this button here. Now this won't move, okay? And we're going to leave it at limit order because we want to get in at 214. If we wanted to just get in at whatever price the market is at this current moment, you would change it to market. Okay? And then this is day. This means that this will only be good for today's trading session. If we don't care how long this order stays on, for instance, if we wanted to get in at $2, 14 cents away from where it is right now, we would put this at GTC, which means good till close. And the reason we would do that is it might not come down to $2 by the end of the day. Might do that tomorrow or the next day. Hard to say, right? So we're going to leave this all like it is. And then in order to execute it, you just hit confirm and send. And this is your order box. Okay, this is your confirmation to tell you what you're doing. So you're buying one Apple contract. You can see that the break-even price for you to have lost or made zero money is 122.14. So this needs to move up to 122.14 in order for you to be at break-even. Our max profit is infinite, right? Apple could go to up forever. And our max loss is $2.14. Our premium was $2.14 times 100, $214 is the max that we could lose on this. Plus 50 cents a contract of the commission and our buying power, et cetera, et cetera. And then what we do is, all we do is go ahead and hit send and it goes off. I'm just going to close that. Okay, so that was how to set up a call. Obviously, setting up a put, same exact process. I'm going to run through this one a little faster. So here's your ask price. This means we are buying, right? And this means that we are looking for the stock to go down, right? A call, we're looking for the stock to go up if we're buying it. Put, if we're buying it, we're looking for it to go down, right? So I'm going to go ahead and buy the at the money 248. Everything looks exactly the same. This time it says put. It's going to cost us $2.48. We hit confirm and send. Our max profit on this is 11,752. The reason it is not saying infinite is because the stock can only go down to 0, right? So our break-even price on this one is 117 because this one's a little bit more expensive, the strike prices or the premium. Okay, so then when we want to go ahead and hit that, we just confirm and send. Now on the opposite side, let's just show how you would sell. Give me 1 second here. Okay, so let's just show for demonstration what it would look like to sell it. So same exact process, except you'll notice that now I'm looking at the bid side. So this would be to sell a call. And when we're selling a call, we're looking for price to do, oh, come on. We're looking for price to zigzag or go down, one of the two. Okay, that's what we're looking for price to do. It's a bearish move. We need it to stay down or go sideways, one of the two. So bringing up this right here, if I were to sell a call, again, same process. Everything's exactly the same, the at the money, et cetera, et cetera. Now here's the difference. When I hit confirm and send, I'm making $217. The whole purpose of selling options is to collect premiums, right? So you can see that our break even on the stock price is 122, right? Like I said, we don't want this to go up. We want it to stay down. If it goes up to 122, I make nothing. And if it goes even higher, I start losing money. Right here, you'll see that it says max loss infinite. So this is why they call this strategy of selling a call a naked call. You are completely exposed to the endless upside of what stocks can do. Stocks can go up forever, right? So that's why they say your max loss is infinite. So on this strategy, the only thing we're looking for here is premiums. So that's why you would sell calls, sell puts. Let's do it on the other side. I'm gonna fix it out of that. Delete this order. Let's go ahead and sell this put. Everything looks exactly the same, right? -1. It's a put, 120 strike. Here's the price. So we're going to collect now $234. Now our max loss is completely different. So obviously this can stop. It can go. This can go down only to a certain point. But you'll notice that this is a little different. On selling a call, we're looking for price to go sideways or down. Well, selling a put is actually a bullish strategy. We are looking for price to go sideways or up. Okay? If price goes down, we lose money. So let's go ahead and clear all these. All right, so so now you understand when you sell these options, the whole purpose of that is to collect on these premiums. And close out of that. Okay, so I jumped to the monitor page here, and I'm going to bring up KHC as an example because when we run out of time, if we bought the November 27th call or bought the put, whichever we did, when we run out of time, if we're down in the trade and it expires, then we're down. It's over. And you can see that I have 10 days left on my craft trade. I've got 10 days left for this thing to turn around. Right now, I'm down on my trade. So I've got 10 days for this thing to flip around. Will it do that? Probably not, but it might might come back a little bit, so my loss is a little less. So I'm perfectly fine with holding on to this till the very end. So that's the important part about why we choose certain strike price, certain dates. Make sure that you give yourself plenty of time. When it comes to buying calls and buying puts, time is not on your side. And I discussed this in a previous class. Time is not on your side. It is not your friend. Time will be eaten away by the Greeks, by this guy right here called theta. Now, we don't really do directional strategies. We're not just going to buy calls and buy puts very often, if ever, but we may. So we're not too worried about that. And all of the current positions that I have right now, they are all based off of premiums. And when it comes to selling calls, selling puts, time is on our side. Like, for example, this KHC trade. I've got 10 days for this thing to flip around. It could do it. Back to completely break even or in profit? Probably not. That's okay. But it could come back down so that I lose a little less money. And then I might even exercise it so that I own KHC, which is a whole nother strategy. But now you have an idea of the strike prices. We want to give ourselves time. The 27th of November is 10 days from now. It's not very much time. I would never give myself that little time for that exact reason that I just showed you with craft. We're gonna run out of time in 10 days for this thing to turn around. So we want more time. So December 4th would be a little bit better in terms of where we are today. Today's the 17th, but ideally, you can see right there, that's 17 days. Ideally, I want to be out no less than 24 days right there. So I would be looking at December 11th and onward for any option strategy that I'm going to do. Any option strategy. I'm looking for December 11th and onward. Okay, that is all I have for you guys on how to set up these options. And stay tuned for more strategies to come.